In a technical analysis, lot of traders use moving averages. But do you know the correct logic behind the moving average? What is the moving average setting that will give you maximum profit? How many moving averages you should use? In this 4-part series, we will backtest moving average with a Python on a 10-year data to find out the secrets of moving averages. Welcome to the moving average backtesting using Python. This is the 4-part series and you are watching part number 1. In this video, you will understand the logic of moving averages and why to use simple moving average in a trading. Before going for why, you need to understand what is a simple moving average. So let us focus it on word by word. First word is a average. You have studied this in school. Average is nothing but sum of data points divided by number of data points. So in case of a trading, it is sum of prices divided by number of prices. So suppose you want to calculate a 5-day moving average. So in that case, you will consider a latest 5 prices and divided by 5. So here is the sum and we divide it by 5, you will get a average. Now what is moving average? As you know, stock prices are time series. That means there will be always time component with the stock prices, whether it is a 50-minute, hourly or higher time frames like daily, weekly or monthly. So as time passes, stock prices are going to change. So with respect to time, we are also going to move the window of an average. So that's why it is a moving average. So in case of this 5-day average, on a 6th day, we will take latest 5 prices and calculate the sum. Again divided by 5. Now what is simple moving average? When we calculate an average, all prices are given a same weightage. If you calculate a exponential moving average, the latest price will be given a higher weightage and oldest price will be given a lower weightage. So based on the type of moving average, formula to calculate the average is a different. But one thing is common in all the moving average is that they all uses the past data, or in this case past prices. Now coming towards the main question, why to use moving average? So for any trader, it is very important to find out a trend of a stock, whether it is in a uptrend, downtrend or sideways, because based on a trend, a trader is going to take a trade. But only stock price can tell you the current trend. We heard the saying like bhav hi bhagwan che. So stock price can give you current trend, but stock prices are random and it is impossible to find out a current trend from stock prices only. So in that case, we are going to take a help of a moving average. Moving averages tells us the past trend because they use just the past prices. So if moving average direction is down, that means past trend is down, not the current. And if moving average trend is up, that means past trend is up. So how we are going to use this in a trading? So idea is to compare the current unknown trend, because prices are random, so current trend is not known to us. So compare the current unknown trend with past known trend. So when the price is going to cross the moving average, that means the price is having opposite trend of a moving average. So how you are going to find an uptrend? when the moving average direction is down and the price crosses from the bottom, that means price has now changed a trend and it is opposite of moving average, so it's in a uptrend. Similarly, when the moving average is up, that means past trend is up, and when the price crosses it from the top, that means price is now have opposite trend of that moving average, that means a downtrend. So you can use these crossovers. See here, crossover is between price and moving average for entry and exit points. Let us backtest some moving averages on a Nifty. So strategy is simple. From what we have seen previously, the strategy is when there is a crossover between moving average, we'll take a entry or exit. Now here we'll consider only long trades. So we'll be using Python for backtesting. We'll backtest on Nifty a simple moving average with value 50. So the strategy gave us around 91% ROI. If you do a buy and hold for same period, you will get around 200%. That's almost double. Strategy is backtested over a 10-year data. You can see each year return of that strategy, and you can also see the other parameters like Sharpe ratio, SQN, and the number of trades to categorize the strategy. Here you can also see the output in a graphical manner. So here red dots indicate the lost trades and the blue dot indicates the profitable trades. If you zoom over a graph, you can have a clear picture. Here the red line indicates a moving average. You can see the simple moving average with setting 50. So when there is a crossover from price to moving average, we'll take a entry, and when the price crosses from the top to moving average, we'll exit. So the entry and exits are denoted by green and red triangles. Suppose if you backtest it by another moving average, let's say 21. You can see the change in ROI. So with 21 you got 66% and with 50 you got 91%. So it is very crucial to find a correct moving average setting that will give you a maximum profit, and we'll be doing that in the next video. If you like this video, please share and subscribe. Thank you.